Stop what you're doing right now. Don't scroll, don't check your phone, don't multitask, just listen. Because what I'm about to share with you is something that was never meant to be public. This isn't speculation, it's not a rumor, it's not a theory. It is a leaked internal memo from inside Morgan Stanley's trading desk, one of the largest banks on earth. And what's written inside that document is deeply disturbing. This message was quietly sent to their largest clients just 72 hours ago. And the instruction is crystal clear. Exit all silver positions, not reduce exposure, not hedge, not rebalance. Exit completely. Sell everything. Be out before the end of the month. That alone should make your stomach drop. You need to understand how unusual this is. Banks don't talk like this. They never speak directly. They hide behind soft language. They use phrases like adjust positioning or optimize risk. They whisper. This memo does not whisper. It screams. This isn't advice. It's an evacuation order. When a bank managing over $3 trillion tells its traders to abandon an entire market, that's not normal risk management. That is raw, institutional panic. That's the kind of panic that happens when the smartest people in the room realize they're sitting on a live grenade and the pin has already been pulled. I've seen the memo. I've spoken with people inside the trading world who confirmed it's real. And I'm telling you straight, this is the most critical piece of financial intelligence you will hear all year. Because when a giant like Morgan Stanley bolts for the exit, something catastrophic is coming right behind them. They're seeing something in their models that you and I will never be allowed to see. They see a storm forming that will destroy anyone still standing in its path. So right now, you have a decision to make. You can brush this off as noise. You can tell yourself it's just another rumor. Or you can lean in and recognize one timeless truth. When the rats flee the ship is already sinking. Smart money always knows first. And right now, smart money is terrified. Let's break down what this memo actually says. It's short, just 3 paragraphs. But every word is deliberate. When you're speaking to billion-dollar clients, you don't waste language, you get straight to the point. The first paragraph references extraordinary volatility and structural changes. In the silver market, instructing clients to close all positions. Long, short, everything. Structural changes sounds harmless, almost boring. It isn't. On Wall Street, that phrase is a siren. It means the system itself is failing. The rules that hold the market together are breaking. Think of it like a bridge you drive across every morning. Structural change doesn't mean slow down. It means engineers found a crack in the main support beam. They don't tell you to be careful. They shut the bridge down, because if you keep driving, it's going to collapse. Morgan Stanley is telling you the bridge is broken. Then comes paragraph 2. And this is where the fear becomes unmistakable. It tells clients to prioritize orderly liquidation over price optimization. That's banker language for something very simple. We don't care if you lose money. Normally, banks want the best exit price. They want profits. Morgan Stanley is saying forget profits. Just get out. Imagine your house is on fire. You don't stop to negotiate the resale value of your couch. You leave it and you run. That's what this means. And they attach a deadline by month end, not next quarter, not later this year. Days. They know something happens at month end. Something big. And they want to be gone before it hits. Then comes paragraph 3. This is the nuclear option. Morgan Stanley states it will reduce its own exposure to 0-0, and it will not accept any new silver business until further notice. Let that sink in. Banks exist to make money. They collect fees on every trade. They love volume. For a bank to say, we don't want your money, is almost unheard of. It means the risk has become greater than the profit. They are shutting their own books. They're not just telling clients to run. They're already sprinting. Banks don't turn away money unless the danger is existential. This goes against their DNA. If they say no, it's because the building is shaking and they don't want anyone else inside. When it collapses, now understand how a memo like this comes into existence. It doesn't happen casually. Lawyers review it. Compliance signs off. Risk management approves. Senior executives are involved because telling clients to sell everything is dangerous. If Morgan Stanley is wrong and silver rises, they get sued into oblivion. Their reputation is destroyed. For them to put this in writing means they believe silence is more dangerous than panic. Their models aren't showing a possibility of disaster. They're showing a probability. So what do they see? Why hit the evacuation button? Because they're watching a perfect storm form. 3 crises colliding at the same time. The first crisis is inventory depletion. In the silver market, there's eligible silver and registered silver. Registered silver is what's available for delivery. Eligible silver belongs to someone else. It's there, but untouchable. Right now, registered silver has fallen below 32 million ounces, the lowest level in over a decade. 6 weeks ago, it was 41 million. That's a drain of 5 million ounces per week. At that pace, inventories hit 0 in months, but the drain is accelerating. In the last 2 weeks alone, 4 million ounces disappeared. If that continues, the tank is empty in 8 weeks. People will tell you not to worry because there's plenty of eligible silver. Ignore them. That silver is owned. and it sells for more overseas. No one is going to dump it cheaply on the exchange. The only buffer is registered inventory, and it's vanishing. The second crisis is delivery demand. The silver market is mostly paper. Normally, only a tiny percentage of traders demand physical delivery, but that number has doubled. Last month, 9% demanded metal. Next month could be 12 or 15, do the math. Paper claims represent 800 million ounces. 15% delivery demand is 120 million ounces. Available supply is 32 million. The math doesn't work. When the exchange can't deliver, it defaults. It forces cash settlement. And the moment that happens, paper silver becomes worthless. The third crisis is counterparty risk. This is the invisible killer. In the OTC market, banks make private bets worth billions of ounces. Many of those bets are short. And some of those banks are running out of cash. Morgan Stanley sees it because banks lend to each other nightly. They see desperation. They see liquidity stress. And in banking, one failure cascades instantly. These three crises feed each other in a feedback loop. Inventory drops. Panic rises. Delivery demands spike. Shorts scramble to cover. Inventories draw in faster. Arbitrage breaks. Physical premiums explode. The paper price disconnects from reality. And once that happens, trust collapses. Morgan Stanley's models show this accelerating toward a breaking point. That point is month end. You might think banks will manipulate their way out like they did in 1918 with the Hunt brothers, or in 2008, or in 2020 with nickel. They did. They changed rules, they canceled trades, they saved themselves. But this time is different. The enemy isn't a single player. It is the system itself. Morgan Stanley almost died in 2008. They remember. Their rule now is simple. When risk models flash red, you don't wait, you run. So why warn clients? 2 reasons: legal protection and orderly exit. The memo protects them from lawsuits, and it spreads selling pressure over weeks instead of minutes. Institutions will listen. Retail investors won't even know until it's too late. When Morgan Stanley exits, expect chaos. Violent price swings. Short covering pushes prices up. Long liquidation pushes prices down. Whiplash. $5, $10, $15 daily moves. Leveraged traders will be wiped out. They don't care about losses. They care about survival. So what do? First, recognize the timeline. You have weeks. Second, choose your side, paper or metal, because they are about to split. Paper is a promise. Physical is reality. Watch one number, registered inventory. Below 25 million ounces, default becomes inevitable. Expect confusion. Fake price drill. P.S. Don't panic, sell physical. That dip is manufactured. Once the whales are gone, the snapback will be violent. Banks don't abandon profit unless the alternative is extinction. Morgan Stanley is exiting. The countdown has started. And there's one final question left. If they're selling silver, where is that money going? I found the data. And what they're buying next is the key to surviving what comes after this. You need to see this chart immediately.